welcome everyone to this edition of Fintech Forum. My name is Ritesh Banglani. I work at Stellaris Venture Partners. So I would like to introduce the guests for today's panel. We have Akhil Handa, who is the Chief Digital Officer of Bank of Baroda. To Akhil's left is Mr. Rajeev Ahuja. He's the Executive Director at RBL Bank. We can start this conversation with a little bit of a light topic, which is what do banks want from fintech companies? So my first question to both the panelists is around how banks go about choosing which fintechs they want to work with. And I would love to get Rajeev and Akhil's view both on the rejection criteria and the selection criteria. I'm sure you are bombarded with requests from fintech companies to work with the bank. What is an absolute no-go for you in terms of a rejection criteria? This is a kind of fintech that we will not work with. And what are the selection criteria? What kind of fintechs do you like to work with?
I'll just give you a sense. There's no science behind it. Perhaps we think in our heads there is a science. But I can tell you 2004 with a VC and a fintech. So I was just saying, जो आता है आ जाए, तो हमें भी सीखना है क्या होता है. And all we had was a middleware API, and we just kept talking about API, so they felt good about it. Some oldie like me was talking about API banking. And within, I would say, 24, 30 months, we got a good sense of what the flavor of the season was. It was payments, acquiring, then lending. And pretty much we were very democratic. At some stage, I know my colleagues in the lending side must have met 100, 150 companies. I think somewhere around 17, 18, some level of, I would say, narrowing down, sanity started prevailing because two things happened. One is the ecosystem itself started becoming more real. There were business, there was, money being not made, but money being earned by fintechs and the banks. And we felt that, look, there's no point trying to be all things to all people just because there's some romanticism about fintechs and banks and how you partner. I mean, we truly believe that we are what we are or can be is because of a lot of the learnings we've taken, via osmosis and partnership. So we said we got to be more meaningful to the people we work with so that their corporate objectives are met and so are we helped in the process. See, ultimately, I think from the period of just discovery, it became a lot more about grafting, looking at farming, just fixing a few things. And what helped for us was that we had rapidly built a payments platform, which was like a backend to many digital companies. I won't say just fintech. So we got a lot of learnings through that. And then our own credit card business actually was predicated around partnerships because we didn't have a base of our own in 2014. So first partner was BookMyShow, actually way back in 2014-15. And today, it's a large platform where we are essentially a partner driven. So there was a lot of learning from there, and it's a very complicated business from a day-to-day perspective. So a lot of learnings. Today, I would say that somewhere around 19, 20, we got a whiff that the bar on, from a regulator perspective, which is what we are seeing in the last 1 year, is going to be raised a lot higher for very simple reasons because there was so much of real stuff and hype in the environment, so much of bad and good stuff. And ultimately, at least in my career, I've seen whenever the regulator looks at it, they look at through the lens of the regulated entity first because that's the one they manage, they have boundaries around it. And so we started sensing some changes and we started raising our requirements. I mean, I won't say standards, that what is your InfoSec. So I'm just giving you the flavor because today that has become a reality and more. Okay, so really speaking, if you are not built with the same stamina, the same capital, strength of the team, which can go the long haul, it becomes a no-no. And then you overlay our own strategic objectives. Okay, so I was just chatting with somebody on the side here. Now today, we stayed away from consumer lending partnerships because we had our own unsecured credit card business. I could not do 5 others and just run a very large mismatched portfolio. But yes, I did B2B. We did B2B, small businesses. Didn't work out much. But today, if you ask me, B2B is our preferred thing. I'm not saying we will not do consumer, but B2B is preferred. And interestingly, the principles of consumer in terms of the environment, development, data are all getting now ported onto the business space. Account aggregator, etc., etc. So we are sensing now actually the move to business to business, starting with unsecured because that's what most fintechs want to do. And interestingly, we are now focused on partnerships where we're going to go secured lending with partners, stroke NBFCs. It's not strictly what you'd say a fintech, but it's really fintech thinking and how you're able to break down an incumbent's model and rewire that. So those are our considerations. What's the, I would say, requirements from a regulator, our own perspective? Because we report everything to the board. And if there's a problem, it's our problem, not the partner's problem, generally speaking. And then what our strategic objectives are. So wherever there's a fit, and we are happy to still experiment. It's not like everything works out. The long answer to your question.
There are at least 3 key takeaways I took from that, Rajeev. One was InfoSec being extremely important. The other was regulatory compliance and a fit with the RBI's regulatory framework. And the third being fit with the bank's strategic objectives. Akhil, would love for you to add, and if possible, can you also share what kind of fintech companies would you not want to partner with?
As a full service universal bank, we operate across payments, lending, cards, deposits, whatever, right? I mean, it's across. We're the second largest corporate bank of the country, right? And that also means that it used to be very difficult for me if a fintech would approach and say, I do X, would you be keen on it? Because my first response always is, I am keen on you. Because whatever you're doing, I need you. Right? But then, we had our, of course, we also seasoned up, we as an organization, we matured our partnerships. We learned our lessons. And some of the key lessons I learned was, of course, the size barrier. I worked with many fintechs that do not scale. And that is an incredible drag on the bandwidth of the organization. So, and hence the threshold that I have now. If you are above that threshold, you're most welcome. If not, we'll wait for you to graduate. Second, right up front, we give you a list of compliances, right? And these are really around InfoSec compliances because much of the fintech operates out of a cloud. Cloud is actually not completely kosher in the banking industry as we speak right now. Right? So right up front, we give you a rule book that this is what it is. And the third, of course, is which should actually be the first one, which is there are now some very key areas that we like to partner. And we like to do deep partnerships in the areas of priority I have. We're very sensitive towards security aspects. We also engage, we get a lot of incoming from international, fintechs, Israelis, Australians, there are quite a few European fintechs as well. And for them, one of the first requirements we have is, do you have a presence in India? We need feet on the street, so that becomes again another barrier. So we have learned, and again, I think there's less of I may have sounded like a checklist, but it's really not a checklist, it's more of it's more art.
Moving on to the next question. Would love to hear some of your war stories. What kind of challenges have you faced working with fintechs in the past? And we'll be very keen to get examples from you on where the fintechs might not have foreseen those challenges, but as you build the partnerships with the fintechs, you discovered challenges down the line that you would want to avoid in the future. Rajeev, would love to hear some of your
So,
war stories.
I think all the stuff I talked about, there's a war story behind each of them. I think the war story was more internal for us, just stepping up in terms of capability because, you thought you were capable enough and suddenly it is overwhelming and there was a lot of, I wouldn't say, some level of conflict between technology and business. And then we had to kind of sit down and build a certain bridge between the two internally. because the business was out getting partners with a lot of dreams, and the technology was saying, look, I don't have, everything was customization. You say, I can't customize everything. And I have a regular business to run, which is extremely vital, and the technology requirements, they have gone through the roof. So I think some of that we had to settle down, and that meant you rationalize what you do, but I think that's pretty much for every organization. I'd say that actually, if I have, I don't know, maybe your next question is, who would you like to work with a partner? I think some of the stuff we are seeing and probably testing out on, I would say, outside of the core infrastructure is very interesting. Okay, so we are now, I mean, we would never use or deploy technology till about 3-4 years ago. It was not, we would stitch it ourselves, but now we are very open and actually using one and now hopefully two service providers, technology providers who are actually coming and partnering and giving us core infra capabilities. And I would say that, and I'm checking with a few friends in the banking industry, I see that changing, you know, that if somebody's developed a very good way, you know, I was talking to Rakshit, yeah, on card platforms. I mean, card platforms, I mean, if we don't have the granddaddy of card platforms here, these are still, you know, very traditional systems, and the consumer requirements are very different. Now, I think those are ripe for a change. And if somebody can build good stacks, and these are exportable as well, so they're not just, somebody mentioned M2P, you know, many of them are exportable. So those are things which will actually now happen, because many of us are now, you know, getting used to the idea of not working with the top 5, top 7 vendors. At least we are now being very clear that core, ours is Finacle, which we will, you know, perhaps use your also is Finacle. And we have our own LMS. In fact, I would say even LMSs are now, people are happy to look at, you know, loan management systems. LOSs are also very good. Halaki, aajkal everybody has an LOS capability, so there's nothing unique about it. But I think many areas where we are happy to partner with core technology firms who can give us a leg up in terms of user experience, risk management. See, one of the problems is if you see the current guidelines which have come over the last 1 year, it's very tough to take our traditional stacks and rewire them for all the changes which people want. And therefore, you need almost to redo your technology stack, and you can't do it. So we are now saying, keep your core as core. So we just got an upgrade to the new version of Finacle. We are not doing anything there which can be changed far frequently because of the need of the market. So some of these things I think are interesting for us now, over and above somebody coming with a business case.
No, just to give you a sense of how important this bit is, I have been talking to banks for at least 20 years. And the one thing that used to be sacrosanct for a bank was their infrastructure. We will not let anyone else touch our infrastructure, will not let anyone else build infrastructure for us. And it used to be the graveyard of startups. You could go 3 years without getting a single POC for an infra product for banks. And this is literally the first time I'm hearing from senior bankers that they are willing to go with startups and not the top 5 vendors, not the IBMs of the world, for actually building their infrastructure, which is phenomenal news, I think, for all fintech companies. I want to move on to a slightly different topic, which is regulation. There's been, of course, a lot of uncertainty around regulation in the last 3 months or so. And would love to get the bank's perspective on what is regulatorily kosher and what is not. And maybe we can start by talking about the impact of digital lending guidelines. As per the digital lending guidelines, what kind of fintechs are, or what business models for fintech are today allowed, and what are clearly disallowed in your opinion, and where are the gray areas?
There is no gray. It is either a black or a white. Till the time we demonstrate something is in white, we don't do it. The regulatory risk, the reputational risk is just not worth it. So from that perspective, that's always the starting point. in the industry, I've also seen that there is a tendency for very smart folks to interpret things in a certain convenient way. If something is not mentioned as a positive, right? As long as it is not a positive, we don't do it. But I've also seen people attempting to do non-negative things. You understand the difference, right? So, from a business perspective, from an activity perspective, we only do things that are absolutely allowed explicitly by the regulation. If the regulation is silent on it, you don't take the liberty of doing it and then testing out later on. The regulator always looks at things from a certain perspective, and if they see that that is going to become a challenge, they have no choice but to clamp down.
Rajeev, let me ask you a very pointed question on regulation that might be on many fintech founders' minds. Is FLDG legal today?
So, okay, I mean, we've been doing FLDG, now we don't do any more for several other reasons. We started in microfinance way back, us and Yes Bank in 2010-11. And it was a way of ensuring your partner stays honest in an operational perspective. And then it migrated to digital lending partnerships. I think if I have to look at it today, FLDG has been commented upon by the regulator, is not yet been concluded. I would basically assume that it's not legal until they explicitly come back and say it is fine to do it. See, again, please understand, now I want to go a little step ahead from what Akhil said, and I'll give you a little bit my thinking around this. So we got religion 4 years ago when we sensed the regulator was asking for a lot of data. And then you start putting the things together, and then you say there's so much of, there is a certain trend in the market where you only hear good things about this is happening, that is happening, and everybody forgets what's underlying that. And we could see the underlying. So we clamped down very quickly, which is why, out of the fact that we don't want to spoil our reputation, we just said, so there was a time when we were like the belle of the ball in terms of partnerships, and suddenly we turned 180 degrees, 2018-19, and say RBL started thinking too big for itself. There was a reason for that. We said we cannot, because the weight of what we were sensing, I'm not saying we had a clear idea on this. Actually, I think the regulator is looking for 3 or 4 things. I mean, and they've articulated it. I think we all as consumers will accept it. Respect for the customer's data. Okay, and that is going to become like the defining thing legally in India now. Okay, so I mean, imagine the GDPR cartwheels we go through. It's going to happen. Maybe it will be a little longish thing. So data usage, data privacy, who besides the customer has the right to the data? It is the engine, which is the regulated engine, whether it's an NBFC or a bank or I wouldn't even say PAPG right now, I don't know where things stand. So that is one, because as a consumer, you will have the same issue, and which is what was violated in some of those cases. Second, fairness and transparency. And I think you'll see that a lot in financial services products. By the way, US also has it. And we only hear of the good part, we don't hear of the bad parts. US has fairness and transparency where they have, and many places have explicit rules on what you can charge, what you can't charge. Third is service and redressal. Big themes for the RBI for the last 2 years. And you take the RBI public comments, service redressal is a big thing. Fourth is concentration. Because data by its nature gets concentrated in larger networks, which is why I think they will not allow one entity to finance the other entity by way of data. I mean, if they're 2 separate entities, or regulated entities and that, and which is why I think their focus on big tech is decidedly that we cannot let big tech, because the entire basis of digitization in India is on public platforms, transparency, and care for the people who are most exposed to it. Okay, and which is somebody who doesn't have the same level of access thinking, they'll do it because it's an app. So I think if you follow these rules and embed them in your business model, operating model very early on, I think the chances of coming to a point where you will have to shut down become far less. See, if you want to build an enduring business, it's a long game. Okay, and sometimes when you don't spend a lot of time and money acquiring customers and figuring these shortcuts out, you may actually build a better business, in my view. Now, there is an unasked question. What does it do to my business model? What can I do as a startup? Because, as a startup, you're supposed to be very innovative. You're supposed to challenge many things. Actually, you need to now embed in your startup and your funding and your capability that, let's say I have to do a product market regulatory fit, not just a product market fit. Okay, especially in financial services. And you'll see this happening in consumer stuff as well. Because D2C, everybody and his aunt now wants to be a D2C entrepreneur. Now, nothing wrong in that. But, there is a long line of quality checks and consistency. So I would say that if you follow these 4 or 5 principles, which is what the regulator wants. By the way, what Akhil did not say is that these digital lending guidelines perhaps intentionally or unwittingly apply to us as well, even though I don't do any digital lending app partnership. Now, I mean, the direction all of us are traveling is that we're going to automate more and more of our things. Now, if you sit from the regulator's perspective, what is the regulator saying? That in a normal paper-based process, there are, by its very friction, there are many things you will examine, you will sign. Achha, isme kya hai? When it's an app, your guard goes down and you tend to, we just download. Do we ever look at the fine print? We don't. So they're saying just because it's digital, it can go viral very fast and people ascribe a certain sense of, I would say, propriety, or it has come from an authoritative source. And I don't mind saying it, the whole deposit gathering through a kind of a UPI wrapper. Now, please think through for a consumer who's putting 10,000 rupees. Arey, ye to GPay ka deposit hai. Fine print could be, and this is the conversation. We were launching it before that. So the question we asked, what would a consumer say? Now, I'm telling you, bankers and NBFCs and you guys would never ask the question. We'll say product market fit, but we'll never ask the question, consumer ke mind mein kya chal raha hai? Consumer say, arey, ye to GPay ka deposit hai. I'm not saying literally, but they will not read its, ABC bank, 3 banks are given. I think from a regulatory perspective, this was a scare. Today is GPay. Could it be another UPI wrapper who would do it? And guess what? The money goes elsewhere and the bank perhaps has no control beyond a point. So these are things we have to take into account because now digital is mainstream. It's no longer an isolated case, which is why you'll see the space narrow. But I can tell you, people who are serious about it, the space will become even more exciting. Because what you're fighting actually is not the regulator. You're fighting people like us and our incumbencies. And once you get that in your head, because ultimately technology हमारे पास भी है, हमारे पास ज़्यादा पैसे हैं, he's got 8 lakh crores, I've got 75,000 crores. But what you're fighting is our incumbency and the way to look at an operating model in a very different way. And sometimes you get lucky when you are timing with UPI and you make such large companies like PhonePe, GPay, Paytm, whatever, and which the banks, as we've been chided last weekend, we gave it up, which is a fact. We don't know what lending businesses will happen when the AA framework becomes mature. You could change the economics of lending for certain segments who don't have access very dramatically. Then his 5,000 branches and my 10,000 people will actually be a burden. So guys, the jury is not that things are bad. Actually, the jury is because the opportunity is larger. And the more successful you think we may have gone, we are, if we don't change and understand, it will become our problem.
So the takeaway for me was we have to check for product market regulatory fit, which means there are no term sheets 48 hours anymore, guys. we finally have to do some diligence.
So I'll use this example of sandbox. If you give them seed money, that's sandboxing for PMR. Okay?
Absolutely.
Which is what the RBI sandbox is for that. And they're very happy to put some boundaries and let you experiment.
I actually have a follow-up question to one assertion you made, Rajeev, which is you mentioned that it might not work for the business model of the fintech company. The regulatory, the strict regulatory criteria. I would love to understand whether it would work for the business model of the bank anymore. Let's say FLDG disappears. Right? FLDG is in a way for the startup to participate in the risk of the loans that they are bringing to the table. Does the bank have the ability to underwrite that customer without the startup or the fintech actually sharing in part of the risk? It's all well and good to say, we don't want your FLDG. But without that, would you even give a loan to that customer or not?
Maybe today I will.
Today you would not.
Today I will.
You will.
I could. And I probably would. 6 years ago, I didn't know. So we used to say FLDG de do, 10%. Somebody would offer 100% because dhanda chalana hai. Today I will. If it meets what I want. See, we've also improved over the last 7 years. We know what we want to do. I mean, today I'm very clear if somebody came with a very good small business idea, which helps me bring down my cost of acquiring, cost of retention dramatically, I will take it on. I'm doing it. Full risk myself. Now, if you're a NBFC, co-lending is the other thing which you can do. I mean, I know it still takes away some part of your balance sheet. But today, I think many banks and many NBFCs are very happy taking the primary risk if all the criteria which he's listed down and what we would like to do, we can get there.
Understood. Great. I have one last question for both Rajeev and Akhil. What new fintech business models are you most excited about at this point? And would love to hear what is on the top of the list for you.
There are largely two models, right? One is a fintech can be a technology provider to you and be an enabler. And the other one is he can be a business partner. And as far as a business partner is concerned, I think co-lending offers a great opportunity going forward. It's sunrise. And we can really together tap into many things. I think we can, all this, the risk sharing and tapping into new areas can be done very well with co-lending. On the technology side, I'm particularly interested and excited by the fact that in many ways we actually run very archaic systems also. Right? And to what Rajeev mentioned earlier, we are also very happy partnering with younger companies because I have actually seen that in many ways, younger companies for niche problems deliver better outcomes. Right? And to that extent, I'm very open at partnering with younger companies. We're looking to make investments, we're looking to acquire. Right? So the entire spread is there. And one area which I feel will get larger, bigger and bigger, and in the context of our conversation as well, you can probably imagine, is RegTech. I think the regulatory burden I think the regulatory compliances for the regulated entities is only going to increase. And as we go more digital, today it's only RBI and a few other regulators we are looking at, and that in itself is enormous right now. The levels of compliances that we do, we submit like 600 returns a month, right? So the level of compliances we do is just enormous. But I also see that, only increasing from here on. There will be multiple government departments who would want it. The regulator themselves will want more of it. So RegTech, I believe, is a fundamental opportunity for anybody who wants to get into that space because it's a completely untapped wide space. If you can do stuff about it, you can automate, you can provide intelligence. I think it's a great area to operate in because as regulated entities, we have to do it. And if you can help us do it, it's a win-win.
Fantastic. Rajeev,
So
what are you excited
outside of the technology which he talked about, I would be very happy to look at harder problems in financial services. There are still, large portions which are, I would say, don't have access to credit. And, while account aggregator and all are good concepts, it'll take years before it reaches many of them. And therefore, you need a kind of almost like a rifle shot solution, which is, like I said, fintech thinking, not necessarily just digital. So I'm very keen on secured credit. I'm very keen on small ticket, lending, where people are not going to be on an app. Okay, how do you rebuild the operating model and economics of that? And I think that's the one which is, I would say, the tougher problem today. Yes, rearranging the consumer deck. People like us and maybe millions more who don't have, but are borrowing money of some fintech NBFC or something. You can say a credit card de diya, usko ye de diya, but that's an easier problem to comprehend. What we would love to do is if somebody can take a very tough problem and is happy breaking it down, spending 6 months to do it, we are very happy to work along, because to me, that is our future. Okay, the rest of the stuff is, sustaining innovation. Okay, nothing is disruptive, this is sustaining. So if somebody can come and tell me, how do you do CV financing for somebody who's not even 1 rupee on CV and 20 more people ahead of us, but how do you just turn the model around? And I'm seeing those happen in very complex projects, because again, think about it that, there is a lot of digitization of documents happening, which is one of the biggest challenges on doing secured lending. If there is some data, there's some usage data, say some supply chain data, etc. You could start thinking, they may not be very large solutions, but if you start small, it could become very interesting. So that's an open invitation to people.
Excellent. So the top ideas we heard from our panelists are infrastructure, co-lending, regulation technology, targeted lending, and secured lending, amongst others. Well, thank you so much, everyone. Thank you, Rajeev. Thank you, Akhil, for the stimulating discussion.